This is a scary time for us. The insurance market is a hot mess, and that has brought us into this crisis. So we are going to talk about how the pricing is on fire. The condos themselves are on fire. The reinsurance is on fire, and even the non-renewals are on fire. So this is all immediately affecting our community associations. They are being hit with all of this. So today we're going to go through certain things. We're going to do the who, what, when, where, why, and how. Who will be affected? Which community associations? What does it look like? And what can we do about it? We're going to have real case studies. When did it start? And how about when will it end? Where is this happening? Why are we in this position? And how can we navigate this? And how can we pay for it? So we'll cover all that today between our insurance professionals, Jim and myself, and our legal team. So we're very fortunate to have the lawyers working very closely with us as Jim and I, as insurance professionals, navigate through this. So let's hit on the pricing. The property insurance market across the United States is in jeopardy. And it's because, for one thing, I mean, there's many things that have led to this, but there's unexpected and unanticipated losses because things have changed. You know, actuaries create the pricing and they set certain expectations. That's what insurance is for. It's for losses, and they expect losses, but they have based their expectations on historical data. But with climate change, and let's just talk about COVID. I mean, who would have thought the inflationary hit on claims would have been increasing the cost of a claim 30% all across America? But due to the climate change, that's where the actuaries can't really anticipate, and they undercalculate. And so, you know, for example, there's straight line winds now. You know, we're in a convective storm area, but that thing called a derecho, whoever heard of that before? But it spread across thousands of square miles through the Corn Belt for 14 hours, and it cost $7.5 billion of unexpected losses. February 2021, a deep freeze across the South. Are we kidding? Those homes aren't prepared for that. They aren't insulated for that. And it cost the insurers $20 billion. The homes themselves, every structure, they had sprinkler systems bursting, they had every pipe bursting. The literal photos are homes with icicles hanging all over their inside. And that was definitely unanticipated and unexpected, and not really calculated for. So going forward, you know, what can we do? I'm hoping for, you know, more sophisticated modeling that is not only historical data, but based on what the scientists are predicting, as well as, you know, we might see some building code changes. It's amazing how in Florida, the Ian's path was so widely hit in a matter of, it varied so much. You could have a home that was built in 2018 with 2018 building codes right smack in the middle of a subdivision that was demolished, but that home stood. So that is proof that our building codes can help sustain some of these weather events. This crisis is so broad that the International Office of Community Associations Institute recently did a survey, and here's some responses from the SNAP survey. This is from risk management professionals. They reached out to risk management professionals like Jim and I, and management and board members, and they got close to 1,000 participants. And here's some actual results from insurance professionals. What is the average premium increase in your property and casualty? That's what we're talking about today, is property mostly. Only 3% said less than 10% increase. But if you look here at that 55% and that 34%, there's anywhere between 11 and 50% increase on the ordinary renewal. And then you can look down further, we can see, you know, 7% had more than 100% of increase. So those are really large numbers, and we have to take them very seriously. So moving on to claims, I said the condos are on fire, and they are. I mean, the claims have been outrageous. So these are specific to condos and HOAs. We see mostly wind and hail. And why is it a big problem? Because there's a bunch of sprawled out roofs in one location. This is not a $20,000 roof claim. This is a $2 million roof claim. These are large numbers. We're also seeing water leaks all over our aging buildings. We can't tell you how important water prevention is going to be in the coming years, because that's one of the things we can control. We can do water sensors and temperature sensors and things like that, where we can't necessarily control that weather. We're seeing the burst pipes. Who thought that Winter Storm Elliott would bring us the real feel of -28 wind chills? I mean, whose pipes are insulated enough for that? Well, plenty of them were, but plenty of them weren't. So the pipe freezes were unbelievable. And then there's the sheer negligence. Let's get real. We know that people start cooking and then they walk away, or they take their sleeping pill, and they are soaking a pot from, yesterday's spaghetti, and they take their sleeping pill. So these things happen. So sheer negligence is definitely out there, and that's part of household living. And then there's fire. When I said the condos are on fire, I mean it. They're on fire. So one of the things about fire is that 98% of fires for structures, not the wildfires, but structural fires, are from a residential source. So that might be the appliances or your wiring, or something that happens in the home, like the candles or the cooking. So that's really important to recognize what kind of claims we're seeing. So moving beyond the claims, we talk about the reinsurance on fire. Jim's going to talk about this in more depth, but January 2023, the global catastrophe reinsurance rates increased by 37%. I'm sorry, Jim, this is your slide. That's why you're going to talk about it in more detail.
Karen O'Connor was on fire. Terry Corrigan was on fire, so I just let her go. But
there you go, Jim.
Yeah, no, absolutely. No, as stated, so we're in a generational hard market. What does that mean? The reinsurance marketplace, which the reinsurance is what, if you go buy an insurance policy for $10 million, your insurance company may only take the first $1 million or $2 million in-house. They then go out to the reinsurance marketplace, and then even those reinsurers go out to additional reinsurers, and it is a global market dominated by 20 reinsurance companies. So the reinsurers are not making money, and they're tired of not making money, and therefore they've increased rates substantially, the most in 30 years. Why? They've been losing money for about 6 years in a row. You can see for every dollar they take in, they're spending more than $1 in claims. And I don't think 2022 is baked into this, but it's not going to get, 2022 will probably be worse, and 2023 hasn't been great either. So, this global reinsurance marketplace is institutional investors and that are expecting a return. When they don't get that, they pull their money out. And then it's just simply supply and demand. There's less supply of reinsurance, the demand is increased, and that results in the higher pricing. Also, the reinsurance treaties, which is like the policy that they sell to the primary insurance companies, they're getting much stricter, which is why you're seeing a lot of underwriting changes and a lot of questions being asked that weren't asked even a year ago. And a lot of insurance companies simply aren't able to write what they used to because their reinsurance treaties don't allow for it. And then also what we're seeing is a decreasing tolerance for catastrophe-prone areas. And you might traditionally think of the coast, California with earthquakes, the East Coast, Florida with hurricanes, as the catastrophe-prone areas. And that's true. And frankly, you don't want to be buying insurance in those areas right now. It's much worse than here. But our region in the Midwest is now seen as catastrophe prone. Getting wind and hail coverage is becoming more and more difficult because the reinsurance treaties don't want to get hung on these huge losses, and the primary insurance companies don't want to be pulled into these very predictable wind and hail claims that they have been. And then, even fire losses with the barbecue grill. So, that's why you're seeing all these restrictions, is because those reinsurers are telling the primary insurance companies, this is what you must do to keep your coverage in place. Go ahead, Stacy. Okay, non-renewals. This is happening to a lot of folks right now, and it's causing a lot of uncertainty in the market. And I'll say, I don't represent American Family, and when I talk about them, I want everyone to know they've been a phenomenal partner to the industry for decades, and continue to be for certain classes of community associations. But they were just simply taking on way too many losses for too long, especially in the garden style townhome villa community association types. And they made a corporate decision to non-renew accounts with 10 or more buildings. Again, you can see the numbers here, the substantial underwriting losses that they've taken. I know we have folks in Kansas and Nebraska and Iowa on here, but specifically for Missouri, American Family in the commercial property and casualty field had the largest market share, more than any other commercial insurance company, about 9% of commercial property and casualty premiums, at least in 2021. And what they wrote was skewed very heavily to condos and apartments. So, it's not easy for a company to make these decisions to willingly give up market share, but obviously it was necessary for them to maintain profitability. And thankfully, they stuck with us this long. I'm surprised they didn't make this decision earlier, but now that they are, we're having to deal with it. They were the last standard market for non-remediated aluminum wiring. We're going to be talking about some case studies of what's happening to those folks that have aluminum wiring that hasn't been remediated. And a lot of the communities that we're seeing affected by this are larger, older communities where not a lot of other standard markets are writing these either. So again, we'll be talking about case studies, what's happening to communities that are facing these non-renewals. It's not just American Family. Middle Oak, another insurance company, non-renewed most of their book in St. Louis and Kansas City metro areas, and they have severely tightened their underwriting capacity and guidelines. And then we're seeing 5 other carriers that have been very active in community associations for a long time, reducing their capacity and also limiting their appetite if you have 10 or more buildings or older construction. And 1990 seems to be the line drawn in the sand. We're hearing this from a lot of underwriters. Leo Insurance, which was a new entrant to this region, very recently said we can't write anything prior to 1990. Go ahead, Stacey. Going back to the CAI survey, which just came out about 2 weeks ago. So this is very fresh data. And this is, again, responses from risk management professionals like Karen and myself. 83% are saying they're seeing a significant number of cancellations. So nationwide, this is an issue. And then premium increases 96%. I want to know where the 4% are. Karen and I might need to move there and, de-stress a little bit. 96% are seeing a significant increase in premiums. And then for management companies, 92% are seeing significant amount of property and casualty premium increases on a national basis. Again, where this 8% lives, that is beyond me. And then a number of cancellations. I think this is 43%. Yes, it should be. It looks like there's a typo here, but about half are seeing a substantial amount of cancellations across their management portfolios. Go ahead, Stacy. All right, I'm going to hand it back to Karen, and she and I are going to go through several case studies just to show you what is happening in the market today.
Absolutely, Jim. And the first case study, we want to set up case studies. We want to go through some just ordinary renewals. Jim talked to you about non-renewals, cancellations. This is just your everyday run-of-the-mill community association, condos or attached homes. And we have 3 case studies here. So the first one is a lovely community association with 38 buildings, and they have 152 units. They're insured for $24 million of coverage. They're masonry veneer. 1986 to 96 is when they were built. They have 8-year-old roofs, so that's good. $25,000 deductible, fairly common. So in 2022, they had $22 million of building insurance limit. The building insurance limit is the greatest factor that drives premium. Whatever that high building insurance limit is, that's what drives the majority of the premium. So in 2023, like most carriers, they are looking at the actual insurance to value. Do we have enough building insurance limit to actually reconstruct these 38 buildings? So the carriers, like Jim said, are having to respond to their reinsurers, and they're double checking all of the building insurance limits. So you're seeing 9% increases in 2023. We have $24 million of building limit because the carrier wants the insurance limit where it should be. They want the premium dollars for what it might take to actually reconstruct. That is a 9% increase. A 9% increase in the amount of insurance you get immediately gives you 9% increase in premium. Okay, so now we know we are getting a 9% increase in premium. If you look down at the 2022 premium, it was at 64,000. And then in 2023, it was up to 85,000. That's an additional 21,000. That's $138 per owner. Now let's look at a little bit of history here. In 2022, this account was new and it got a 7% savings over its incumbent company. But now look, now 2023, it's taken a 32% increase. 9% of it was for the increased insurance limit, and 23% was a pure rate increase because the carrier, like many, are taking rate increases. So that's one of the first case studies we have. And then we've got another one that's also just ordinary routine. Now the one before was more of a stacked unit development. This one's side by sides, and we have go ahead, Stace. We have another 38 buildings, 76 units this time, frame with vinyl siding, 2001 year built, so it's a little newer. 12-year-old roofs, that's getting a little sticky. $10,000 deductible, that's a little sticky. Pretty low for today's environment. So claims, yes. So 75,000 of sewer or drain backup was paid out in 2022. In July of 2022, to be exact, because 26 units were affected. And also they have a $15,000 water claim from a broken pipe in 2021. So how does that affect the renewal? In 2022, their building insurance limit was $24 million. But in 2023, like the other case study, they want the building insurance limit up to $26 million. That's 8% increase, which is again an immediate 8% increase in premium. So 2022's premium was $59,000, and 2023's premium is not $84 million, it's $84,000. Sorry for the typo there. But that's $25,000 additional. That is a 60% increase. 34% of that was rate, and 8% was insurance limit increase. Now, one of the things about this property that's notable is that this was an unpredicted weather event. Again, these convective storms have been crazy. This was last July, July 26th and July 28th. July 26th, we got 8 or 9 inches of rain in 1 hour. That's what caused the sewer or drain backup in these units. Now, if you look at this property with the blue dot, it is not in a special flood hazard area. But if you look at the areas all around it in the blue, those are zone AE. Those are special flood hazard areas. Stacy, if you could use the pointer, then you could show them. So see, the property itself is not in a special flood zone area, but it's surrounded. So if you have that situation, you might be alarmed, and the insurance companies are now alarmed, and they're probably not going to give you sewer or drain backup coverage anymore. But that's just things that we need to start looking at. Even though we're not in that flood zone area, we're so close that when we get these unusual storms, that's probably going to hit us. So now I'm going to turn this next one over to Jim.
Sure. So case study 3, and again, we're still calling these normal renewals. I don't know if those really exist anymore, but this is a brand new villa community in a really nice suburb. The developer controlled the insurance program up until this year. We see this a lot when there's developer handover of the insurance program to the board. Developers are somewhat incentivized to underinsure to keep the costs low. And this developer had the buildings insured at $115 per square foot. In the governing documents, the association is actually responsible for ensuring the interior of the units, including any improvements or betterments made by unit owners. And the governing documents required full insurable replacement costs. They did not allow the board to underinsure. Go ahead, Stacy. So we were asked to take a look at it and move it from developer control. We used a software called CoreLogic to recalculate the cost per square foot. As you can see, it went from $115 to $250 per square foot to meet that full insurable replacement cost requirement under the governing documents. Deductibles were increased to lower the impact of more than 150% values. But you can see here, 154% value increase, more than doubled the square foot, almost doubled the property premium. It's an 83% increase, and without increasing the deductible from $5,000 to $25,000, it would have been well over 100% increase. So the board made the decision, in my opinion, a wise one, of bumping those deductibles up to control costs.
Okay, so now we're going to get into some actual non-renewals, and these can hit anybody. As Jim mentioned, we have one particular carrier right now. If you have 10 buildings or more, you're getting non-renewed. But there's other situations out there, as Jim mentioned, and with the reinsurance, I mean, the underwriting is just so strict. So in this very first case study with regard to a non-renewal, this happened March of 2023, so just a couple months ago, and they were non-renewed due to this fire claim, which you can see, and they didn't get it fixed. So what happened in 2021, and it was still unrepaired in 2023, but on top of that, they would not get rid of their grills. As you can see, there's grills there, there's grills, and the insurer is just not going to tolerate it anymore. And so because of that, they are non-renewed. We have $16 million building insurance limit on this property, 23 buildings, 98 units, masonry over veneer, 1967 construction, and 23-year-old roofs. Not desirable, not to anybody, even without the claims. And then with the claims, we have March 2021. It was only a $450,000 fire. I say only $500,000. But again, March 2023, it's still boarded up. February 2019, they also had a $10,000 slip and fall on the stairs. That screams a little bit of lack of maintenance. So with that, here's the big shocker. Here's what their premium did. The expiring price was $65,000, and now it's $165,000, 2.5 times. What's different now is when we take these non-renewed severe cases, they have to go into the secondary market. The secondary market is quite different. So from the next case studies on that we talk about, it's what happens when a community loses their coverage for various reasons. They're in the secondary market in this case, and that means all the premium is due in full, 100% on that March date. Did this community have an extra $100,000 laying around? They did not. So, and with these secondary markets, 25% of it is non-refundable. So you think you're gonna, oh, I'll pay it and then I'll go out and get something better. Surely there's something better out there, but there's not. And even if you did find something, 25% of that premium is non-refundable upfront. Then on top of all of that, the premium, because it's due in full, you have to engage a premium finance company. In this particular case, we're seeing the interest rate on the unpaid premium between 9 and 19%. In this particular case, it was 12%, and it was an $8,000 finance charge. They had to come up with $50,000 in order to secure the actual coverage, and they didn't have it. And the proposal, the secondary market proposal, which Jim and I will talk to you about, was received 3 days before the expiration. So we are trying to prepare these communities for what is coming, how much they're going to have to come up with, and all of that through these, how we navigate through all this. The next case study is a non-renewal in April of 2023, simply because they had 10 or more buildings. But in that same breath, they also had a claim. And so they're captured in the middle of all this. And they don't know they're going to get non-renewed, right? So they have 35 million insurance limit, 37 buildings, 155 units, frame construction, 1984 to 1986. So everything I just told you right there is enough to make the market hard, that they can't find coverage. They have too high of insurance limits, too many buildings, frame construction, and built in 1984. Then they have roofs from 2003 with no plans to replace until 2027. No roof replacement schedule that's funded. We have to see proof of that. An electrical inspection turned up Challenger electrical panels, which I was not very aware of those, but that eliminated one of the markets. It was on one of the list of electric panels that they won't accept in one of the secondary market carriers. And on top of all of this, in the middle of all this crisis, they have a $670,000 fire that's due to unattended cooking. And one of the questions that came back from all these secondary carriers is, what measures have they taken to prevent another fire of this nature? Well, there are things such as under the hood fire stops that could have been inserted, but this community did not. And that's okay. This is all, everybody's learning, but there are things and steps and measures that people need to start considering. So let's look at how their premium panned out. They went from $140,000 to $382,000 in premium. It was a 272% increase. Again, the premium was due in full, 25% fully earned. Their interest rate on the premium finance was only 9%. Lucky them. And so they had $12,000 premium finances, and they had to come up with $95,000 in order to secure the coverage in April of this year. Their secondary market proposal was received 5 business days before the expiration. This account was prepared because they were notified that this is kind of how the secondary market operates. So if you're unprepared and you don't know what's lying ahead, that's when you're going to get in trouble. So we're trying really hard, Jim and I and the attorneys, the legal, it takes everybody to prepare these communities for what this might look like. And let's look at what the policies look like. I mean, when we talk about the secondary market, we went from one American Family Master policy that provided property, earthquake, and general liability. And then we had to assemble a puzzle in order to ensure this full layers up to the, I think we're at 35 million here, yes. So the first policy number 1 from insurance company number 1 gave you $5 million. Policy number 2 from insurance company number 2 gave you the next $5 million. And then we had to get a third layer that is a typo also, that is a $25 million layer from company number 3. Now, company number 3 might not have wanted all 25 mil, so sometimes they'll share that also. But in this case, those 3 carriers provided the primary property, but they don't want the earthquake. So earthquake is coming from insurance company number 4, and they also don't want the liability, so that's coming from insurance company number 5. So that's what it takes to create the puzzle. And I know Jim is going to speak to this later, but if you were to engage another broker, if that the way the insurance industry works is that whatever broker gets the application in first, that's who that carrier will work with. So suppose that middle layer, that 5 million in the middle that we needed right after the primary 5 million, is gone because another broker got their application in there because we were waiting to secure the first 5 million. Then we can't get the next layer, layer 3 and layer 4. Nobody's going to quote layer 3 and layer 4 if I don't have layer 2. So that's what happens when we get into these really, really complicated situations. We're literally putting a puzzle together. So with that, Jim will get into that as well, but here he goes with some actual non-renewals for aluminum wiring.
Yep. Thank you, Karen. So Karen and I and the attorneys have learned everything we never thought we needed to know about aluminum wiring over the last few months. But if your community was constructed between mid-60s through about 1982, there is a chance that you have aluminum wiring. If you were constructed between 67 and about 78, there is a very high likelihood that you have aluminum wiring. The U.S. Consumer Product Safety Commission has done multiple studies over the years, and the home fires, aluminum wiring construction or construction that used aluminum wiring before 1972 are 55 times more likely to have one or more wire connections reach dangerous fire hazard conditions. So this is why the insurance companies, your primary insurers, don't want to touch these. Their reinsurance treaties that we've talked about previously strictly forbid non-remediated aluminum wiring, meaning if you're buying that $10 million policy and your primary insurance company only expects to pay, $2 million of a $10 million claim, if there's aluminum wiring, they would have to pay the full 10 million, and they don't want to do that. It's hard for them to stay profitable if they can't get reinsurance. So that's why there are really no standard markets left that can accept non-remediated aluminum wiring, and actually very few that can accept even remediated. Go ahead, Stacy. Okay, so here's a case study. This was a end of 2018. American Family non-renewed an account. They had some deferred maintenance issues, including non-remediated aluminum wiring, but they had some other problems. So they were paying about $3,600 per million in replacement costs in 2018 before that non-renewal. We went out and we had to go take them to the non-standard market. And this is in 2018. It was about $6,800 per million. So not quite double of what they were paying. Their deductible increased $5,000 to $25,000. So this community went out and they saw that they really needed to remediate, and they completed at the end of 21 Alumicon remediation, which is the preferred method, by the way. I won't get into the technical side of what the electrical contractors are doing, but most insurance companies are requiring Alumicon as the preferred remediation method. So they had some other deferred maintenance issues. We had an insurance company pre-inspect them to make sure there were no grills on decks. All their decks were in good condition. The roofs were in good condition. The grounds were, also look good. And so their price went down from that $6,800 per million to $3,700 per million in 2022. The deductible stayed at 25,000, so they had to live with a higher deductible. And past performance is no guarantee of future results. I think if they had waited until a year or two more, they wouldn't have been able to obtain the same insurance proposal that they got in last year. Definitely not this year after the reinsurance rates exploded. If they had not remediated, I believe they'd be paying 11,000, that should say 13,500 per million in coverage today, instead of that 6,800 they were paying with non-remediated aluminum wiring in 2018 and going forward. So you can see what the market's done. It's doubled in just a very short period of time. So here's a community. This is actually just got a proposal delivered Friday, so very fresh. This is a May 2023 non-renewal by American Family. They do have non-remediated aluminum wiring, but their roofs are new. They had no claims, no grilling on decks. It was a really nice, well-kept community. They had a reserve study in place. I mean, they were doing everything right, but they just had aluminum wiring. And that's really the only critical issue with the community, other than there's some roof exposure as well. So they were paying $89,205 for their property insurance, which actually that policy ends later this week. And that is increased by 180% to $250,000. So you can see the rate didn't quite triple, but close to it. The deductible increased from $10,000 to $25,000. Their earthquake, they had full earthquake coverage, which I know those of you in Kansas City and Omaha and areas west don't care about earthquake, but here in the St. Louis metro area with the New Madrid fault zone, earthquake coverage is critical. So you can see their earthquake coverage is less than half of what they have. We got the quote 5 business days before the renewal. As Karen mentioned with her accounts, premium 100% do it binding, but with a finance agreement, we need $62,500 down. There's an 11% finance charge, or about $14,250 in additional costs above and beyond what the premium is. Go ahead, Stacy. All right, here's one. Whoop. There we go. Here's one from March. So this is a community that had non-remediated aluminum wiring and then a lot of other challenges going on. So this is a late March 2023 non-renewal by American Family, 38 buildings and 302 units. About 2/3 of those units, we think, have non-remediated aluminum wiring. Barbecue grills all over the decks. Which again is a big no-no. There was a $3.3 million open roof claim, which was less than half of the roof. So every roof in the community was being replaced. Less than half of them had been completed by when this renewal happened. Underwriters do not like open claims. They really shy away from when there's any sort of open claim. Whatever you can do to get those closed out well before a renewal, if possible, work to do that, because we had a lot of insurance companies decline, not just because of these other issues, but specifically because of that large open claim. So prior to the renewal, we had just shy of 50 million in values, a $10,000 deductible and a 2% wind hail deductible. They had full earthquake coverage, almost $50 million. Their property premium was $202,858. Go ahead, Stacey. So here's what it looks like after the non-renewal. The building values were found to be low by almost every insurance company. So there was a $10 million increase in the building values. Earthquake limit was chopped down to 10 million is all we could get without purchasing very expensive excess earthquake coverage. The deductible went from 10,000 to 100,000, except the wind hail went from 2% to 5%. and I didn't put this on there, but there's also actual cash value on roofs older than 12 years old, meaning they'll depreciate any claim for those roofs. So all of those roofs that hadn't been repaired yet were essentially going to be excluded from coverage. And we had a 328% increase in the property premium due to both the rate and the increase in values. So $663,706. That does one thing we didn't mention is when you go to the non-standard marketplace, you pay a 5% tax in Missouri. And I'm blanking on Kansas and Nebraska, but I believe it's the same in both those states. It's either 3.5% or 5%, but you pay taxes. And then often you're paying some smaller fees, like a wholesaler fee, inspection fees, stamping fees, or whatever other fees they invent. This one had a 35% minimum earned premium, or $233,000. They financed the remainder of that premium at an 8% rate, which added an additional $18,300 in a finance charge. Quotes, because it took 7 insurance companies just on the property, 8 when including the general liability, and we were up to 12 once we had all the lines of coverage put in place: directors and officers, crime, they had work comp, auto. And so we had to create a layered program with 7 insurance companies to get to that $59 million limit. And then, the underwriter threw on this potential to reduce rates after remediation, removal of grills, and after that claim is closed. We'll see that this community has a little bit of a ways to go to tackle all these challenges. But, this is somewhat the worst case scenario. I know Karen and I saw one earlier this year that's actually worse than this, that ended up dropping coverage, which the attorneys are going to get into that a little bit later. Minimum earned premium, I just saw something pop up in the chat, which I'll go ahead and address this now. So minimum earned premium means that the moment you bind coverage, you owe that amount. If you cancel after 1 day, too bad, you owe that amount. So we as brokers cannot accept that kind of risk, because if you don't pay it, guess who pays it? We do. And therefore, oftentimes, just to bind coverage, Karen and I have to collect that minimum earned up front. And so if you're facing a non-renewal and your cash flow is a little tight, you might want to shore that up very quickly, just so you can have coverage in place when the policy expires. Early lessons that we've learned, we're 5.5 months into the year. What we're finding is a lot of communities with non-remediated aluminum wiring have a lot of other issues. So we can fix the wiring, but we got to fix a lot of other stuff to get back into a better non-standard market, or maybe even a standard market. So Federal Pacific and Zinsco electric panels, these challenger ones I'd never heard of until recently myself. We're seeing there's usually a lot of claims issues, deferred maintenance, those decks. If those decks are rotting, underwriters are going to see, or inspectors are going to see that. Barbecue grills. Most municipalities have fire code that doesn't allow any open flame cooking within 10 feet of any residential building. And we're seeing just a lot of wood decks with grills on them. Wood burning fireplaces. This has become a big issue. I had to tell a community you can't use them anymore. And the board had to pass a rule that no one can use their wood burning fireplace. That was just to get a renewal offer from the incumbent market. So really it's, if you have non-remediated aluminum wiring, there's probably a lot of other stuff, and it takes a lot of time to get compliance from all of your neighbors. And therefore, it might be a year or two before you can work your way back into a better market. I'm telling anyone with non-remediated aluminum wiring, expect 150 to 300% increases. 150 might even be optimistic, to be frank. I think that 200 to 300% is probably a better estimate. So if you're facing that, you're not going to be able to remediate all of the units prior to your non-renewal date, I would budget for this type of increase. Then we're also seeing, as we showed, go back, Stacy, I'm sorry. So we're seeing a double whammy, construction price inflation, which we demonstrated, it just costs more to repair and build buildings. And so we're seeing, 15, 20, 30% increase in valuations plus a property rate increase. And then one thing that we've learned this year is a lot of insurance companies have what they call a fire rate load factor. So let's just say that their fire rate is $1 per $100 in coverage, just making up numbers. They will add for non-remediated aluminum wiring, they're going to add 40 to 50% to that dollar rate. So now you're, $1.40, $1.50. If you have a Lumicon, it's $1, $1.20, $1.25. And if you have older remediation, it's $1.35 to $1.40. But the issue we're finding is a lot of the markets in the non-standard world, they have higher base rates to begin with. So if you're kicked into these non-preferred markets, their rates are higher than a lot of other insurance companies, and then they're debiting those rates even further. Again, that's why we're really encouraging folks to remediate, because what happens is, even though you might end up in the non-standard marketplace, you're still probably going to have a better base rate to start with. The other issue is with the aluminum wiring is most insurance companies can only put up 1 to 2.5 million in-house before they have to go get reinsurance. And that's why we're getting these really goofy layered programs. And this is actually this is a $400 million layered program, bit extreme, but you can see sometimes what has to happen in the jigsaw puzzle that Karen and I have to work out to get coverage in place. And if you miss anything in the middle, or you're blocked in some of these middle layers, it can make the whole program fall apart. And then the other thing we're seeing is something called quota share. So that community that had a $60 million value that we just talked about, the first $5 million were actually 3 insurance companies doing a quota share program, because none of them could take more than $1 to $2 million on a primary basis. And then it took 2 insurance companies to get the next 5 million, and then 1 to get above that. We are finding that for large communities, getting full limits, it's challenging. I won't say it's impossible. It's just really expensive. And, we're having to involve a lot of insurance companies just to get full limits. We already talked about multiple brokers. We have seen recently a couple of proposals for communities with non-remediated aluminum wiring from insurance companies that we know for a fact do not write any aluminum wiring, remediated or not. If you get one of those, ask the broker to put in writing that they have disclosed that to an underwriter. What happens if you don't? You say, hey, I need to save some money. I'm going to take this proposal, even though I know my wiring is deficient and this insurance company won't accept it. If you have a fire, they could deny that based on fraud by the insurance broker or violation of underwriting standards, the fact that you didn't disclose it or intentionally hid that from underwriters. A lot of communities are asking us, okay, if we remediate, what's the return on my investment of the cost of remediation? How long is it going to take in lower insurance costs to pay for it? We're calculating anywhere from 3 to 5 years for the Lumicon remediation method. That's about how long lower premiums will make up that additional cost of remediation. Complete rewiring, we think it's going to be about 10 to 12 years, though very few communities can afford this option, and it's very disruptive as well. So again, subject to many other underwriting factors, every community is going to be different, but this roughly is what we're seeing. If you remediate, you can't have every unit owner go out and get, Uncle Bob and, who maybe does side work and does remediation. So our underwriters are asking for one contractor's letterhead certifying the date that every single unit, we need every address listed on that letter stating that your unit's been remediated. And this is the date we completed it. And in addition to that, the local county came in and inspected, and here's that inspection permit as well. So we are submitting that to underwriters and able to get better rates once remediation's been complete. In absence of all that documentation, don't even do it. It's usually a waste of time. The market is evolving very rapidly. It's Karen and I are very friendly competitors. We talk almost every day, sharing notes to help our community association clients, because there's just so much changing. So, you might see us probably later this year doing something again, just because there's a lot of changes happening. Go ahead, Karen.
Thanks, Jim. There's one question that came in that's really significant right off Jim's topic, which is what recourse is there if the broker doesn't disclose facts to the underwriters and the insurance claim is denied? Well, typically the client signed that application, and does the client read every question? Because in the state of Missouri, the only time a carrier can actually call a policy literally null and void, meaning there was no coverage ever in place, will return every dollar of your premium, is when there was a material misrepresentation on the application that's so blatant that it's something the insurer would not have taken on. They would not have taken the risk on. So what recourse is there? You'll have no coverage, and good luck collecting from that agent's errors and omissions insurance 10 years down the road. That's the recourse I can tell you. Jim, do you have anything to add to that?
No, you're exactly right. And I would expect at minimum substantial delays in getting a claim paid, if not an outright denial of especially a fire claim. So I've seen that the date of construction has been changed from maybe 1972 to 1985 on applications. I've seen, again, the aluminum wiring question marked as no when the board has disclosed that there has been. I've also seen roof update information falsified. So, we get it. Karen and I understand you need to do everything to contain costs, especially since all these other costs are going up. Don't do it at risk of having a substantial claim denied. I mean, you might have 1 to 2 years of pain with these much higher premiums. I'd rather see you work through the issues, do it the right way, and not risk it with false underwriting information.
Yes, and thank you for all the other questions. We will try to get to those. That one was very pertinent to what right off the tail of what Jim was speaking on. So now, what do insurance companies look at? This is true for everyone, whether you are aluminum wired or you're just brand spanking new, whatever the case. And one of the property management companies asked me for a list. Gosh, there is no actual list because every community is so very different, but they're definitely looking at the number of buildings. A large number of buildings, 10 or more, 15 or more, means that many roofs. So they don't want the roofs here. We're in a convective storm area. What is the total insurable value, which is the actual building insurance limit? The larger the value, the harder time they're going to have actually placing the coverage. So once you get over 20 million, we're looking at definitely at reinsurance at that point, but also just some carriers that will just refuse to entertain it. Age of the property. Unfortunately, as Jim mentioned, American Family has been very favorable to some of our aging properties. Once you lose that coverage, I'm not sure that you're going to get back into the primary standard market. It's going to be very community association specific. So right now, they're all really strict, where they used to take pre-1990 buildings. Now they won't. Every kind of rule is different. So that's definitely a factor. The electrical systems. With aluminum wiring, like Jim said, comes the possibility of Federal Pacific stab lock or Zinsco electric panels, along with all kinds of other host of complications, wood burning fireplaces. So we're going to have to look at that fire risk. Also, the roof age and replacement plan. Roofs 10 years and older should have a replacement plan, and it should be funded. And there should be proof of that. The more that we can give to an underwriter to say, not only did they create a roof replacement schedule, they are funding it. They are putting this much money aside into the reserve fund. I will tell you that once the roofs are older, the companies are often placing actual cash value on the roofs. And so that can hold up loans. If the mortgage company that you're trying to sell your unit to a buyer's mortgage company and they see actual cash value on that certificate of the insurance on the master policy, there are loans definitely denied. It's happening right now all over the place. So that's a new pleasantry for 2023. But also, there's this misconception out there about roofs. I hear all the time, it's got a 30-year warranty. We paid more for the 30-year warranty. Well, the 30-year warranty means that the manufacturer warrants that if the shingle is proved to have a defect in 30 years, they'll replace the shingle. It has nothing to do with the life expectancy. So that's really there needs to be a new learning perspective on roof age. And then claim history. So the frequency and the severity, the stacked buildings are getting a lot of water claims. You've got to watch that. A lot of storm claims. I suggest higher deductibles. That's the only way to prevent claims. And grilling restrictions. Most companies do not allow any charcoal. And everybody seems shocked at that. But no, there's not charcoal allowed. Have you ever gone to Florida or some of these other states? There's no charcoal grills going on. And most grills have to be 10 feet from a building, as Jim mentioned in the building code, and no grills on combustible decks and balconies. That's just going to be the way of the future. But Then wind and hail scores. So these insurers, they have things now. They have tools. They have something called risk meter. And so where it used to look like an absolutely beautiful community, sure, I can get a quote on that. And then they come back and say, no, too high of a wind score. Oh, well, how would we know that? We don't know that. But science and modeling is helping these insurers underwrite. They're doing crime scores. I had a property in St. Charles and an insurer turned it down for the crime score in St. Charles. They didn't like what was going on around the neighborhood. So that brings us to some stats, again, from the CAI International Office. These are, again, responses from insurance professionals. What are the contributing factors to the rising premiums and the non-renewals? 83% said age of the community. 76% said age of the roof. 76% said the total insurance value. 72% said claims. We've got aluminum wiring, number of buildings. I did want to point out one thing in particular. 17% in the second column said late premium payments. Insurance companies don't like the fact that you might let your coverage lapse and then want to be reinstated because there's a gap. There's a potential gap there. That leaves room for litigation and all that. So sometimes they're just not accepting the late payment anymore. They're done. I think a board member said it best in one of our recent meetings, is that where the community used to interview the insurance company, it's now turned around and the insurance company will be interviewing the community. And if there's late payments, they aren't necessarily going to want to entertain that account. So as a recap, how did we get to this point, Stacy? So American Family Non-Renewing Associations with 10 or more, that just came down. That rule just came down January, February of this year. We didn't know this was happening. Why do we think it happened? Reinsurance treaties, January 1, 2023. Why do we think it happened? $1.5 billion of underwriting loss in property. So we didn't know this was happening, but this is what brought us here now. Last year, another insurance company non-renewed many condominiums in our area. That was 2022. So it's unsure who's the next insurer that might want to consider non-renewals or stricter underwriting, whatever the case might be. We are in an insurance storm, and it might carry over to next year. It is truly unknown. The lack of capacity in the insurance marketplace is from the losses. The reinsurers don't want to be hit again, and so they're pulling back on their capacity. So millions of dollars of coverage in one place is not desirable because the reinsurance companies don't want it. And that is what's resulting in the non-renewals, the denial of the reinstatements, the stricter underwriting, and the huge price increases. And as Jim and I are seeing, the routine claim-free condominiums are seeing 25 to 50% increases. I know that nobody wants to hear this, but we are suggesting that nobody makes significant changes right now. If one carrier happens to be lowballing it right now, it's just a matter of months before they catch up. And did you jump to the next carrier that's going to be looking at non-renewals? We don't know the answer right now. So we're suggesting that people stick this out. It's a storm. We ride out storms, right? We don't abandon ship. That's where we're at right now. January 2023 reinsurance rates, as Jim mentioned, they were the highest a generation has seen. That is incredible. So there's more. Hot mess, Barbie. So this is all, again, 2023. Since January 1, 2023, standard insurance companies have been players in our community association world for 30 years, are now adding actual cash value to any roofs 15 years or older. What does that mean? We have to show on the certificate of insurance that the buyer lender is asking for. We have to show actual cash value on roofs. It's gonna end up in some denial of loans. One of 2022's hottest markets, hot market, looking for business. Jim and I both went crazy. Shut down, practically shut down for new business. Another new hot market used to be pretty open. They wanted newer, nice properties, right? They would look at different ages, but now 2023, they came down and said nothing older than 1990. And then another player, a big company that you all know, they used to look at insurance, master policies and conversions and everything up to 100 years old. This year, we asked them and they said, no, anything under 30 you send our way, but that's it. So this is where we are today, and it's changing. Like Jim said, it's evolving, and we're just holding on by the seat of our pants and trying to share everything we know with you all. And with that, I'm going to turn it over to legal.
Well, good afternoon, everyone. Thanks, Karen and Jim, for the rosy picture. It's fine. All we can do is laugh, right? All we can do is react. So every time we present, we always go through the next two slides. And when it comes to the legal side, the key thing to recognize is one, in terms of statutes in Missouri, or actually in most of the heartland, nothing's really changed. But it doesn't mean things haven't come out or we haven't learned anything. It really is recognizing that in terms of the statutory responses, we're not Florida. We're not chasing anything. So a lot of what Karen and Jen talked about were a lot of practical implications of what's happening. So for everyone attending, I always like to say we never expect board members or managers to have a working knowledge of this hierarchy, but you have to recognize it's there and you have to issue SPI. Okay. So let's go ahead and Stacy, go to the next slide. This is where we would expect a board and a manager to have working knowledge of. Most instances, the declaration of the bylaws, wherever the insurance provisions are located, they're there, and we generally know the bylaws if there's something with the declaration, but you don't always necessarily know the statute. So every once in a while, it's not too common, but every once in a while, you're working off of the declaration of bylaws and you just forget or don't ask that, hey, was this drafted consistent with the statute or is there something else out there? So you have to recognize that these two hierarchy sources of authority, even though they're relatively static, excuse me, all you have to have is something that you assume to be correct and it's not because of the statute or a used case came out. So let's go ahead and go to the next slide. So you have to remember what you live in because that matters whether or not there's an applicable statute or not. So in non-condominiums, what do your documents say for Missouri? Kansas does have the Townhouse Act, which actually follows an old act condominium model. But you have to know what you live in because then you need to know what statutes are out there to apply. In a condominium, you have to recognize you have the distinction. How is the property divided? It's divided into common elements and units. And that matters because that's how when you draft the declaration of bylaws on insurance provisions, common elements is usually easy. Where it gets messy is how are the units described, to what extent of the units are covered. And we generally use shorthand to describe the three most common approaches. One is bare walls, which is actually extremely common in California, which is the association will restore the unit to its bare walls. That's it. Original specifications is the most common that I have seen in Missouri for condominiums, and even in villas. It's kind of if it works in the condo world, very common to see in the townhouse or villa style as well. And that's original specifications. The association will insure the unit to its condition at the time of the original sale to the first buyer. Now, there's obviously difficulties in that if you have a lot of variance. So let's say it's more of a custom community. So the builder will sell it to you one way and then you pay for the developer to finish it or customize finishes. It depends how that transaction was done as to what the association insures. So you can create some confusion as to, where's the line for the master policy. You also have communities that age that get a lot of customization. That presents problems there. All in is by far the easiest to understand, which is the association will restore to the date of the loss. So one way to think about it is bare walls is exactly as the name describes. The other one is original specifications, the date of the original sale, and all in will give you the date of the loss. So living in what you live in, set some defaults, and then you get to the document. So Stephen, now you get to talk about the good old act.
Thanks, Todd, and thanks, Karen and Jim, for kicking us off. And sorry, everyone, we've probably scared you so much, but thanks for being here today. So I'm going to take us through a couple of statutory sections, as Todd referenced there before, and I know that's very exciting after being on with us for over an hour now. But thank you guys for paying attention and being here, because this is important information, of course, for you and your communities as we weather this storm. We're going to be talking about two statutes in Missouri, in the Missouri statutes right now. I know there's similar language in other states, but I'm going to be focusing on this Missouri language as we talk here. This is important because, as Todd just mentioned, we don't have like a common interest community or homeowner association act in Missouri. So this is really what we have to rely upon for condominiums. And so there are, as many of you know, there are two condominium acts. There's the Condominium Property Act, or as we refer to as the old act for pre-1983 communities. And then we have the Uniform Condominium Act for post-1983 condominiums. And as I said, there's no statute governing other types of homes, but what's important for our topic here today is that when you're dealing with insurance, oftentimes townhome and villa style communities are insured as though they're condominiums, but these statutes don't generally apply or don't apply. But at the same time, sometimes in those declarations or indentures, you'll see language that is mirroring or copying in whole or in part some of the language from the act. And so it's important to have an understanding of what that language is, what it means, where it's coming from. When we talk about kind of next steps or remedies or possible solutions later on, it'll differ what type of community you are. So it's important when we're looking at this to think about, am I an old act condo? Am I a new act condo? Or am I not in either of these groups here? So we've got kind of three different boxes we're dealing with. So under the Condominium Property Act, that's the old act, pre-1983, this is the statute that we're referring to dealing with this type of insurance. And as you see it in 448.120 there, that the insurance that the board has to obtain for the property is for the full insurable replacement cost of the common elements and the units. So you just heard Todd referring and describing those two different types and how those lines are. But for an old act condominium, the association must insure the full insurable replacement cost of both of those, the common elements and the units. So there's no, as it says in the notes, there's no limiting language for what portions of the units or what portions of the common elements. We're insuring all of it. And there's not a carve out for what we're going to see on the next slide for the new act for what is the reasonable availability of insurance. So if you're an old act condominium, you don't have the benefit of these carve outs. And in fact, you've got to insure for all of it. Talk about situations where the declaration, the statutes have differing language or approaches or requirements, and that can be more of an issue for communities under the old act. What I will say is it's very important. We want to make sure that we're looking to what the statutes say. We're reading the declaration. If there is some sort of discrepancy, or really if you're ever find yourself thinking maybe I should be interpreting the language of the declaration of the statutes, that's the point where you should probably be picking up the phone or sending an email to your attorney anyways. Todd, you want to talk about the North Carolina law?
Yeah, North Carolina's condominium act has similar language as to this. And the question was, well, the declaration had a different approach. And the court said, that's nice. The statute says what the statute says. So, and this comes in little just the preview in the Uniform Condominium Act. It's more express. It's clear that, hey, this is what controls unless we tell you you can vary it. So the Condominium Property Act doesn't give us that answer. So in North Carolina, they said the statute says what it says. It doesn't say it can be varied. We don't know if it can be varied, so we're going to follow the statute, and that's the end of it. We don't have that case law in Missouri, so we don't know what a court is likely to do when you have a mismatch between what the old act says and somehow some limiting language within a declaration.
Thanks. Yeah. So I think everybody ultimately, that's what we're focusing on here is, there's a number of situations, and we'll talk about some later, where you may say, we want to be in court to resolve this. And there's some situations we're hoping it doesn't get there where you're in court where you don't want to be. But some of the analysis that Todd and I and our colleagues are looking at right now is what can we do to, protect you as an association if you have to make these difficult choices and end up in court in a way you don't want to be. What steps have you taken? What analysis have you done? If the statute says what it does, let's make sure that we're at least trying to meet those minimum requirements in the statute. And so now the slide has moved to the Uniform Condominium Act. That's for condominiums post 1983, and there's a specific date there, but we'll just, if you have a question, let us know. But so if you're a new act condominium post 1983, here's what the statute provides. It says the association shall maintain. So again, the association has this requirement, but then it has that bolded language, to the extent reasonably available. And we're going to talk more about that because that's a qualifier. That is a carve out, a limiting language, to the extent reasonably available. Spoiler, we're going to tell you in a minute, we don't know what that means. The courts in Missouri have not told us what that means and how that language is to be interpreted. Todd and I and our colleagues have some ideas, but so for a new act condominium, the association is required to maintain property insurance on the common elements. Unlike the last slide where it said property insurance on the common elements and the units, here it says property insurance on the common elements. And then that second paragraph below, we have a carve out or some additional requirements for language for condominiums having horizontal boundaries. So that means when you've got units stacked on top of each other, how we talked about that in the earlier slides. So when you have condominium units that are stacked on top of each other, the association is also required to insure the units, but doesn't have to include the improvements and betterments installed by the unit owners. So that means that we have to go and ensure that original specs, the as-built design of the builder when they originally sold this unit, but we don't have to insure those improvements and betterments that have been installed by unit owners, even unit owners prior to the current owner of the unit. So that's important, of course, for individual owners to know that if they've got significant improvements and betterments in there, and the association's policy is ensuring to the requirements of the statute, it's not going to include that those improvements and betterments, which obviously many times can be very expensive. So again, so just summarizing for the Uniform Condominium Act, those post 1983 condos, it's insurance on the common elements alone, unless they're stacked units that have these requirements for unit coverage. And again, you always need to look at the declaration, of course, for any additional coverages, but we want to make sure that this is understanding what the minimum requirements of the statute are. So we talked about stacked units. We talked about non-stacked units, that it's the common element coverage and extent reasonably available. I think we're getting into that on the next slide, but well, there was a comment there, yeah, on the bottom, and this is to the Uniform Condominium Act. So this is just a general comment about that language there, that the association can comply with insurance coverage requirements, even if coverages are unavailable or unreasonably expensive. And so that gives us some idea of what that language, when it was drafted, might mean. So we can go to the next slide. And this is really where we're talking about, what does that mean when you say that it's not reasonably available? As I said before, there's just not case law in Missouri that tells us what not reasonably available means. And so when we're going through this analysis, we're trying to make sure that we're, protecting you and thinking about what a court might want to look at, or what a court might consider in saying, oh yeah, that's not reasonably available. So we saw in the comments there that we're talking about if coverage is unavailable, and if it's unreasonably expensive. So again, unreasonably is a little bit difficult there, that we've got not reasonably available and unreasonably expensive. But so coverage unavailable, obviously that's maybe a more of a clearer situation when there's coverage that's simply not available. But what you've heard from Karen and Jim is we're dealing with situations where the cost is very high, or you're not in the standard market. So we're dealing with other types of non-standard markets, or other types of coverage that is having to be obtained at a much higher expense. And so that's a situation where it's less clear, and we want to make sure that we're looking at that and exploring our options. So what is the amount of the price increase? What coverage is available to the association and to the unit owners? What are the efforts you've taken to look into and obtain coverage? What efforts have you made to limit other expenses of the association so that you can afford to pay insurance? What efforts have been taken over time to fund reserves for future increases in costs? What efforts are you taking to assess your owners, special assess your owners to fund the needs of this insurance? What other impacts you see here? What on short-term necessary repairs and reserves? The availability to finance? Are you looking at borrowing money to fund these premiums? And we know it's expensive, but what are you doing to be able to obtain insurance so that we know that it's maybe just unreasonably expensive, or simply just not reasonably available? Todd, you have anything you wanted to add on this slide?
No, you really did cover it. And just to slightly unpack it, it's at the end of the day, no matter how much documentation or how much evidence you have, if there's an insured and otherwise insured loss, and we don't have insurance, you're getting sued. That's just the practical nature of it. There's going to be a lawsuit, even if you can show reasonably, everyone sitting here can say, yeah, in our opinion, it's not reasonably available, or it's too expensive. That doesn't mean anything unless a judge says it. So these are the things that we think are the best factors to consider, but there's no prohibition or bar to someone challenging these things.
And to kind of piggyback on Todd's point there, oftentimes, if the association were to get sued for not having, being properly insured, not obtaining the insurance that's required, that's a typical exclusion under directors and officers insurance policy. So not only might you get sued for not obtaining sufficient property coverage, but you also may not have coverage in defense of that claim. And so that's something we also need to be careful about. Going on to the next slide. And so this goes into what is that next step, right? The new Condominium Act the Uniform Condominium Act post 1983 provides us a requirement that if insurance is not reasonably available, the association has got to provide notice to the owners. But my recommendation is to take that a step forward, further than that. I want to make sure that we are taking proper action and sufficient action as a community, as a board, so that the owners are informed of this situation and we can properly document the decision that's made. So, my suggestion would be to have a board meeting that's public and noticed to the owners, that the board, obviously records in the minutes, after weighing those factors we talked about on the last slide, looking at the various factors that are available, considering what's happened, likely having potentially your insurance broker there to explain the options and the process that's been gone through, and actually making it to the board's going to consider that and make a determination in the minutes so that we have a record of it and the analysis that was taken. And then you're going to provide that notice that you've got to provide by the statute here afterwards. And I would say, even if you're not a new act condominium, but you've got similar language as a townhome or a villa that allows you some flexibility as opposed to an old act condominium, that you should take these steps to provide sufficient notice and to inform the owners of what's going on. I think this has my picture on the top, but I think this one was for you, and I'm happy to do it.
No, it's fine. So this is again, the risk of not having insurance, and Stephen, you hit the big one, which is, I'm not aware of any D&O policy that provides coverage for lack of insurance, but I'll have to defer to Karen and Jim on that. So just Karen shaking her head no. So yeah, so there's no insurance coverage. So again, and to piggyback off last slide, you're not going to get in trouble for not providing enough notice. Okay, so the more notice is always better. So, we sent the letter like we said. Okay, that doesn't mean it's enough. So there's no problem in sending more notice than less. So some declarations, depending upon the drafter, they may have carved out or not properly copied the act when it comes to this extent reasonably available language, whether that's a condo or the non-condo, but they're using the condominium model of insurance. So you have to work with the lawyer to understand, what do our governing documents say? I am huge on making sure, it's just incredibly important. Governing documents should reflect what the community wants, because that's what's setting our expectations. So if we have an expectation that we're going to provide insurance and then we're not, you're creating that lack of expectation, that lack of certainty, and that lack of certainty and understanding is typically what leads to these kinds of disputes. Karen already mentioned the lenders. Access to financing may become difficult or unavailable. I fully anticipate that is going to become much more common. Whether, I think the St. Louis and Kansas City resale markets have been strong in terms of, compared nationally to the housing dips. But at the same time, it seems to ebb and flow on how much the lenders are looking at. For example, on the Freddie Mae and Freddie Mac addendums, early on I was doing a lot of them, and then they kind of stopped, and now they're coming back. So there's an inherent ebb and flow with lenders. That is what it is. The condominium will not be eligible for FHA condominium project certification. And restoration promptness, under the UCA, an association is required to promptly restore. And that can come in a lot of different variations depending upon what the issues are and the obstacles. The key for the board is, when those obstacles come up, that it's properly documented as to why. It's rarely the association just not wanting to do it. It's usually maybe there's a dispute with the adjuster, or maybe there's a dispute between the association's the unit owner adjusters and the association, or you can be in a fight with the city or fire department. The key is to document as to what are the challenges that are forcing the delays in restoration, even supply chain. Document it. Don't just, well, they said this. No. I want the email. I want the report. I want something to show what is the delay in restoration. Stacy, go to the next one. There you go. Steven, you're back.
I think this was yours too, but happy to do it.
Well, how
So-
about this? You wanna
Go
do the, well, you've done the, actually, I think we said we're gonna do this one.
Whatever you want to do, happy to do.
Well, let's do this. Let's do this. So I think you had one where, or you've seen where the association allocated the insurance premium.
Yeah, so the first one, the top here, this is a provision in the Uniform Condominium Act, although we see similar language in other types of condos and other types of communities. And, you know, what we're dealing with here is when I recently encountered this provision, well, a few years ago now, was for a community that was dealing with the aluminum wiring remediation that we've heard Karen and Jim talking about. And the way their documents were worded is they did go to the owners to do the work with a contractor that they had kind of worked with and had given a plan to do a bid to do the work, but it was an individual unit owner expense, and that's how they intended to do it. I think there was an ability to have had the association take on the whole project, if I recall this community's documents correctly, but they didn't have the money on hand or didn't want the burden of actually conducting the project, making all those arrangements for access to individual units. But in this community, there were a few unit owner holdouts at the end, right? So in order to get this discount on your premiums and save the money by doing the remediation, what matters is that all of the aluminum wiring is remediated. I don't think we heard Karen or Jim mention anything about a situation where, well, we're 90% remediated, so that's a 90% discount, right? That's not how this works. It's all got to be done, and it's gotten stricter over time, where now, that one contractor, as you heard, has got to sign off on it. You've got to have the county inspections, everything else. So maybe today this community wouldn't have gone down this route, but it ended up working out because I think there were 2 or 3 owners left at the end that said, I'm not doing this, remediation in my unit. I don't have the money, or I don't care, or you can't make me, whatever it was, you name the excuse. Well, the association had this language or a similar version in their documents where, to the extent required by the declaration, so it's got to actually be in the declaration itself, the cost of insurance shall be assessed in proportion to risk. And so they went to their broker at the time and said, how much extra do you think this is costing us that these last 3 units haven't finished their remediation of aluminum wiring? And they got the numbers. The broker ran those comps for them and figured out what that price difference was. And ultimately, we ended up sending a letter to those unit owner holdouts saying, you've got to take care of this by X date, or else the association's going to assess you the additional insurance cost that's being incurred as a result of the risk you're refusing to take care of. And so that, sure enough, was much more significant than the individual cost to those owners to actually do the remediation itself. And a little bit of a prisoner's dilemma there, right? Like, if you're the last one holding the bag, the other 2 do it, you might face that full premium. So different. So that got them to take care of the work. And so that was one tool that we have kind of as an option in trying to get owners to actually take care of something that's their obligation and it's causing a big problem.
Yeah, I've been fortunate where I've mentioned it, but I haven't had to do it. So, that's fine as long as it works out, right?
Right.
Now, the one part in Stephen mentioned this, it is to the extent required by the declaration. Excuse me. There was a case, it was litigated. It actually says what that means. So there were some owners that related to the limited common element portion of the section. And the court said, look, the statute says to the extent required by the declaration. This is an example of what does the declaration say. The act is saying the declaration can vary it. So what does the declaration say? So below the 0.3 of this section is 0.5. This is not discretionary or subject to variation. This applies all the time and relates to misconduct. Any common expense as caused by misconduct, the association may assess that expense exclusively against the unit. Well, what's misconduct? There was I don't know if it was a gentleman, let's just pick on guys for a while, who decided to pay his assessments in pennies. And the association hired an accountant to count the pennies. And the association said, you are going to pay for the accountant's charge. And the court said, yes, that paying in pennies can constitute misconduct. So misconduct isn't contrary to law. It can even be something that's actually permissible. Paying your bills with pennies is allowed. Legal tender. So misconduct is just very fact specific, but it is another tool that can be used. Particularly, I would look at it as particularly for grills. This is a way to get to the insurance premium question if your declaration might happen to have that language, because if the association is very aggressive about, hey, you can't have a charcoal grill, and the owner wants to complain, well, guess what? Building codes already don't allow it anymore either. So now you're aligning, to say that it's not misconduct when it's not even authorized by ordinance, just adds more weight to it. So it's a tool that can be there if the drafter of the declaration of the drafter of the declaration did not grab this option that's available under the Uniform Condominium Act.
And one more thing, maybe we can just throw on to that slide, last slide too, is you guys may notice that in the first section I talked about, it says shall be assessed. And in the section Todd just talked about, it says may. So this is something that, of course, the lawyers look at when we're analyzing statutory language and declaration language, where that means that if you have this language that the cost of insurance shall be assessed in proportion to risk, that means that that's an obligation on the association. The board shall do it. Where if we're in the 5 dealing with misconduct, this is where the board has more discretion to analyze it in the way that Todd was just talking about and determine if this is a situation where they're going to take that step and assess it back to the unit owner. Next slide, please, Stacy. So this is a slide that we're talking about. Here's some options that we can consider for trying to remedy this or address these issues here. I don't know, Todd, you want to kick this off?
Yeah, I think it's, and again, as I mentioned before, we want governing documents to align with what we expect of each other, whether it's the association or the owners insuring. And you have to, essentially, you have to go down that rabbit hole. The old act does have that question that we left open to, again, you have to follow the, the association insures all of the unit or not. But the old act, more broadly, just doesn't have the depth of the UCA related to those things. So just because we say, oh, well, it's very short on insurance, therefore all the other questions related to insurance are answered, are just not true. So the Uniform Condominium Act does have less flexibility, but it adds more depth in terms of how claims are going to be handled. So amending the governing documents to you have to work with your attorney to make sure that the governing documents are reflecting expectations and everyone understands what they need to do with respect to this language. Litigation, I think that's, this slide is kind of summarizing. Steve and I borrowed from Stephen in helping coordinate some of these slides. So I know Steve and I agree, access to remediate, that's not a thing. Owners have to give us access to remediate if they're not only obligated to. Not related to insurance, I've had to file lawsuits on access. Stephen, have you had to go the full distance on that as well?
I think this is one where we've threatened and haven't had to go that far because there's language in that statute also that allows that chargeback of the fees, right? So, I mean, right. People, when it says it in black and white, eventually people tend to agree, right?
Right. I've also never have had to done a declaratory judgment. Essentially, we go to court and say, we think the insurance is unreasonably available. Court, will you sign off on it? That is a way to essentially pre-litigate before there's an insurance loss and say, look, based upon everything we did we satisfy the statute or not? And that can be done. But again, it's not, you have to weigh and talk with every board has to talk with the agent, broker, and the legal counsel to decide whether or not that's the most appropriate next step.
We have
already mentioned the failure to maintain.
And we actually have used declaratory judgments, not for this insurance context, but for other kind of questions where the declaration or governing documents aren't as clear as they should be on certain topics, where the court actually will intervene and determine what the language is and what your obligations and your powers are. So this, for the right situation could be an opportunity and an option for a community. Now, I know you usually don't want to be the one spending the money to, make law. But, if there's a real situation and you've got some lead time where you could go to court and say, it's just not clear what not reasonably available means, or it's not clear what our options are because we just don't have, there's not insurance available in this situation. What do we do? It says we have to have it, but there's just not insurance available. You're an old condominium or another type of community without, flexibility. Maybe this is a route to get some court intervention so that you have some protection down the road, so that if an owner or there's a loss or an owner wanted to sue, you would have said, well, we've been to court and this is what the court told us it means and what our powers and duties are.
Right, and then the last part, just the, well, I guess Stacy's done. She's done. She wants to go to the next slide, talk about that. Anyway, we already talked about the allocation of premium, but again, that's a consideration. Now, Stacy, you can go to the next slide. Where Molac, who wants to talk about Molac and begging for money?
I'll do it.
There you go.
I'll put on my president cap. So, my apologies for those in Kansas and Nebraska, but MOLAC is the political action committee here in Missouri. And frankly, in Missouri, we are having some struggles right now, working with the legislature, even though everyone should be applauding the LAC for their efforts this year in defeating some really nasty bills that would have been a detriment to our industry for years to come. A few things we didn't like got through, but for the most part, it was a good session. And so, we've really ramped up our advocacy on behalf of community associations here in Missouri. We have folks in Kansas as well that are working with the Kansas legislature. And so we have to have funds in order to do that, primarily to fund our new lobbyist who's doing a phenomenal job. So if you're able to and your community is able to, please donate. If you're not able to donate to the LAC, we'd love to hear from you, especially if you're having issues that are centered on state law and harm or issues that it's doing to your community. Maybe it's with developers, maybe it's with, could be a lot of other things. So please get involved. Click on that link when Kathy just posted it to the chat. So if you're able, please donate. And I'll shut up and we'll start answering questions. Who wants to
We should make Stacy do it.
Stacy, you want to moderate questions or?
No. She's gonna kill me later. Don't volunteering her.
There's so
I
many.
would be happy to moderate the question.
Great, thanks, Stacy.
Some of them have been answered already, but here is a question. In an old condominium, what if you do not have any original specifications? What is the standard for insurance?
I think Mary's question is I think what it's getting at, builder grade. In other words, if you don't know what was original, I think they're using, the adjusters are going to builder grade.
Yeah, it is. And Karen and I see this often where it's an older community and no one knows what's been updated or not. So a lot of times you just have to establish a baseline. Ultimately, it's the unit owner's responsibility for knowing what they need to insure on a personal basis in their unit. So it's not really an association issue until it becomes one. And if they're underinsured on their personal insurance policy, suddenly it becomes an association issue because you got an upset unit owner. So if you're in an older community, I would just advise those owners to maybe bump up their dwelling limit A coverage more than maybe what they think it should be, meaning the interior of their unit, any improvements or betterments that they're supposed to be insuring, just increase it by 50, 100,000, whatever the number should be, just to be safe. Karen, do you have any other?
No, that's good. I mean, that's it. The adjusters will go back and try to find the one unit that a little old lady lived in and never did any changes. That's what they'll look for.
The next question is there standard insurance coverage in Missouri?
I think that was related to the same question, Stacy. She was just asking, she wanted to clarify that the standard she was asking about was Missouri.
And then there are some other questions that came up. Grilling. What about electric grills?
I think, Jim, I don't know, but I think the question is, what about electric grills on balconies?
Decks.
Yeah, and so I mean, it's going to be insurance company specific, and there's no good answer except they're becoming more and more strict. So don't go invest in a lot of grills. Pretty much, if you tell them electric grills are okay on decks right now with your particular insurance company, you want to move to another insurance company and they're not okay. So there's no good answer right now, except the safest thing is to keep fire away from the buildings.
So there's a question that we have a insurance perspective answer for, but I think it would be interesting to get the legal perspective too. Can the individual unit owners up coverage to cover elements of insurance that previously would have been association coverage? So I guess, unit owners insuring everything instead of the association, common elements now insured by the owners instead of the association. Legally, what would be a suggestion there?
Karen and Jim, if I recall, the H06 policy only allows for coverage of the dwelling as it's defined. Correct.
So let's break it out.
Yeah.
Is it a condominium that has true common elements, and therefore the owner is trying to insure the commonly owned roof with an H06, which is a unit owner's policy, and it just doesn't extend to non-owned roofs. It doesn't, you can't apply it there. Let's break it down to an attached home development, which is different because then the roof is not a common element. And the owner typically owns the roof all the way from the center line of the party wall up through the roof. Then, because the owner owns that commonly shared roof, they can insure that in the personal insurance homeowners market.
And of course, the Uniform Act also says that, an owner can, nothing in there, stops an owner from buying as much insurance as they want. So you could certainly acquire as much insurance as you want. But I think what ultimately what Karen and Todd are saying there is it may not be worth it or do anything for you. So don't go there. And obviously it doesn't remove the obligations of the association to acquire insurance as put forth in those statutes of the declaration.
I found we're talking to a lot of communities who are considering, especially townhome communities, can we just drop the master policy? You really need a good attorney to make that decision. One of the things we're finding is maybe the insurance section allows for it, but then you have a maintenance section of your declarations or your governing documents. And often that section is stating that the association is responsible for maintenance and repair of roofs or siding or whatever could maybe be considered a unit instead of a common element. And so you're not just amending your insurance documents, you got to go and amend other sections as well to make unit owners now responsible for repair and maintenance of the roof, or else their personal insurance company may not foot the bill because we've got a legal document stating they don't have to.
And so I think there's several questions about aluminum wiring, and what would you, I guess, summarizing them, what would you suggest as far as an inspection plan, and then owners complying and being required to make updates, board control of the plan, letting owners taking owners' words for their updates on their electrical, what's best practices to make sure that that's done correctly?
Karen and I will take the owner's word. I haven't found an underwriter that will. So an owner can put in writing that I remediated my wiring 5 years ago. I'm not going to do anything else. Well, it's unfortunate, but underwriters don't accept that. If there's aluminum wiring in the community, we're going to need something on contractor letterhead and or inspection permits from the local municipality or county. Short of that, it's, you know, Karen, have you seen any other way to get around that?
No. The association has to have control. And to that point, there's another question in here. I'm going to jump in because it's directed to legal. It says we're remediating aluminum wiring. All but one of 108 units have been initially inspected. One owner refuses inspection from our electrical company. Says they have copper wiring certification from another electrician. What can we do to get this last unit inspected? This is to identify what is needed for remediation in each unit. So that, again, hop to legal on that.
Well, that's a great example of just because it ties into the what would be best practice. And a lot of it is the practical, not the legal, which is if the underwriter is not going to take that electrician's report and certification, it doesn't matter then. It is worthless. So so that owner can complain all he wants. It's nice. The association has the right to go in and verify. And that's what I would suggest to that association, that most likely that's what they need to do. And Steve and I kind of mentioned the other thing, because if the underwriter doesn't take it, it doesn't matter what we think or what we want. It just doesn't matter. So best practices, yeah, it's about control. It's about working, not only is it, the lawyer, it's Karen and Jim, or the agent, the electrician, it's everybody has to coordinate these things so everyone knows what needs to be done and what's acceptable or not. If the association is doing the vast majority of the work, great. But if an owner is really insistent that they want to use a third party, then we have to work with the underwriter to see, is that even viable? And what documentation will the underwriter accept? And then they got to deliver it. If they don't deliver it, then it's as if they did nothing, and we proceed that way.
There's some questions about making sure that owners have their personal policies, specifically loss assessment, coordinated with master policy. And with all of these changes going on from an insurance perspective, what can you advise owners when making these changes?
Aaron, you want to tackle this one?
Well, I don't see the specific question, Stace, but basically, I mean, we're going to rely on our brokers, right, to communicate what the changes are. Now that we have a new $100,000 deductible compared to the old $25,000 deductible. That means the master insurer is not stepping in until there's been $100,000 of damage. That takes a lot. So that pretty much means the onus of insuring the guts of that unit have fallen directly onto the unit owner. So again, communicate. You have to be aligned with a broker that understands the coordination between a master policy and what a unit owner is responsible for. I hope that answered the specific question, Stacy.
There's a follow-up question about limited common elements. The question is, I assume those should be insured as well by the association. So maybe talk about
the limited common elements are common elements, that they're just a subset. So when they use the word common elements in the law, they mean LCEs as well.
Question, and if an association is considering turning insurance for the units over to the owners, they've kind of touched on this a little, what is the requirement? Then would an amendment to the declaration be enough with a vote of homeowners? And this seems like it is not a condo, it is a villa style community.
I would be shocked if an amendment is not required from the get-go. Remember, when you're outside the condominium world, your governing documents say what they say. And you can have, and I have had it where I saw a declaration that I think by accident, they created an avenue to help a board out in this situation, but I don't think it was planned. I think it was truly an accident. So again, that's where you're working with the association's attorney and the broker or agent to understand the risks and what needs to be done to make that change. But again, except for one unique situation, which I highly doubt is going to be repeated, I'd be shocked if an amendment is not required.
Yeah, we'd like to be able to tell you, here's the the miracle pill, here's the answer for every community. And unfortunately, like a lot of things with, at least in Missouri, where we don't have it as standardized, it's going to be community by community to look at what those documents say and what the needs are and what the options are in this market for your community. And so we can deal with those factors and try to help you with a solution.
If your community is weighing the option of having the owners insure the residential structures instead of the association, you got to remember there's a lot of other repercussions of that. Lenders, so everyone who has a loan on a unit, their lender is expecting them to be insured under an HO6 with a master policy through the community. That's how they wrote the loan. That's going to change. So, I think you just, again, and then we talked about the repair and maintenance section of many governing documents that requires that the association repair and maintain roofs. Well, so it's not just amending one section. There might be multiple areas where the governing documents have to be amended. Get a good attorney is all I got to say. So.
And
The
you
And with
next-
still have-
also those 5-day before kind of lead times, it would be great to have a little bit more time than the eve of the term of the cancellation to be able to try to figure out a good plan for you on these sort of things. Because as Jim's pointing out again, it is a very complicated change. You're talking about something pretty major when you're shifting the burden and obligation for this, and not to mention other things that the association is going to continue to insure if there's any sort of common amenities or other areas that the association is still going to have a property, have to insure some property likely. So are we, what's going to be left? And there's just a lot of moving pieces there.
I have
Um,
one.
Just
I'm
to-
sorry,
ahead.
Tracy, go ahead.
Sorry,
I just have one. It says by refusing to issue insurance to dwellings built after 1990, is this a workaround to the laws against redlining?
No,
No.
it really has nothing to do with redlining. And I do understand, maybe why that question's being asked. It's simply an underwriting. It's a common underwriting criteria is age of buildings. And because older buildings just simply tend to have more issues. And that's really all it is. And these insurance companies are analyzing claims over many thousands of community association clients, and they use that data to predict where they think claims are going to happen. And many of them are finding it's these older communities. There's a bit of a crisis of deferred maintenance going on nationally with community associations. A lot of communities are using insurance as a maintenance plan, and therefore that's really what's happening. I wouldn't say there's any redlining.
Every time here, I'll jump in.
Yeah.
Every time I have an association reach out to me and say, we're looking to hire a public adjuster because we think the master policy isn't doing their job. Every single time it's a roof. Never has it been anything other than a roof. And why is that? Well, that's because, we think we had a hailstorm a couple years ago. Your roof is already 25 years old. They know you're trying to use insurance to get a new roof. They know it. So is it a specific community's fault? No. But when you take the marketplace as a whole, when we talk about, and Jim and Karen will say, don't use insurance for maintenance, don't use insurance for maintenance. That is still happening, even though all of us here have been hammering away as to not do that. It's still going to happen too. So everyone in the marketplace is bearing the brunt of those bad actors as well. But every time I've had a public adjuster, we need to talk to a public adjuster. Every single time it has been over.
So there's one, the association gave the windows to the unit owners by a bylaw amendment. I think the question first, we need to specify, maintenance versus insurance, and was it given as maintenance or under insurance? But assuming that the unit owner now has to insure the windows, does the insurance company need to know about the amendments?
Typically, no. I mean, the owner should know about the amendment. The unit owner's insurance is still only responsible typically for the amounts below the master policy deductible. And then a master policy is primary, whether it's windows, doors, or once the damage breaches the deductible. So they don't have to know it's windows. They're just going to adjust the claim. Did the claim breach the $25,000 deductible? If yes, the master policy pays for what's above the 25,000. And if no, then it all stays under the unit owner policy. So, I mean, that's a very complicated answer and question.
Well, another way to kind of help synthesize all this data is when you have a covered claim, whether it's the unit owner, the master policy, just the unit owner, whatever. As long as there's enough money under the policy, there's rarely an issue. Okay, so you also have right, well, is it the windows, whatever. You know, yeah, there might be some confusion. If we all agree it's a casualty loss, then everything behind the scenes is the dispute about which bucket is it going to come out of in terms of insurance. But it's only when you hit the policy limits that things get really, really scary. And so something as minor as windows, I would, like Karen said, I'd be shocked if that comes up in such a way where we have to go run around and tell lenders. But if there's a shortfall of proceeds to restore a condo, yeah, every single owner and every single lender needs to know what's going on.
So, does the HOA have a duty to determine if owners have working smoke detectors?
I like the word duty, so go ahead, Todd and Stephen.
Yeah.
Say the question one more time so everyone can hear it.
Does the HOA have a duty to verify there are working smoke detectors in the unit?
Very
And we're
well.
talking about in the units, right? We're not talking about in the common hallway.
It
Yeah.
seems.
So the question is, it really comes down to basically this. A lot of associations will have in there, an owner is obligated to maintain their unit. So the question is the association negligent in checking the owner's failure to maintain the unit? Part of it doesn't really matter, and I know this sounds weird. Let's say the owner knew it and torched the place anyway. Well, guess what? The master policy covers. If it is an insurable loss and the master policy is triggered, liability doesn't matter as much as people think. We want to punish them. They didn't have it, they didn't do this, whatever. The question is, does the master policy trigger or not? If the policy is triggered, the association has to restore. Where it comes into the liability is, can the association allocate its deductible back to the owner for them not failing to maintain the unit? Maybe. But if an owner wants to go down that rabbit hole or another carrier, I think they have a hard, they're going to have a hard time doing it unless the association had a reason to know that someone was not maintaining their smoke detector.
And then, of course, you go with that smoke detector is, you know, would that smoke detector going off have changed that? There's already a fire at that point, right? Presumably we've already got a fire. So would that smoke detector have changed, you know, battery in there have changed the outcome and the damage to the bill? There's a lot of other questions that go on, but, you know, a lot of communities you'll see, they'll put, you know, notices or reminders in a newsletter or something like, hey, be sure to check the batteries on your smoke detector, or be sure to have your dryer vents cleaned, or things like that. You know, I mean, rarely, I don't think I've ever seen a community say, hey, we need access to your unit because we're going to check your batteries and your smoke detector. That's not something that communities are generally going to do. But you know, obviously reminders, you know, not a bad thing to have out there.
Yeah, I don't, could the documents do what Steven, just better phrase like Steven said, the association will go in and do it? Could, I've never seen that either. So is it possible that an owner is gonna sue the association for, you know, not doing that? Sure, and insurance is still the primary tool of managing those lists.
Next question, if an owner wants to cover the cost of updates in their electric service, which runs through the common elements, maybe the attic, I'm guessing, that are not inside the unit boundaries, is notice by the board required to inspect the common elements or adjacent units for updates?
I think that one's too specific to that particular association. We'd have to, I think Steve and I would agree. We'd have to look at the governing documents to see how they're set up.
I agree.
And then the last one is once the board decides on an electrician, can owners make individual appointments with the electrician? That seems a little association specific as well, don't you think?
Go ahead, John.
It's really specific to the electrical contractor. I'm aware of one contractor that set up an online portal where owners can go and individually set appointments. I've had others that don't want to deal with 100 different owners. So you're gonna have to talk to your electrical contractor. The critical thing on our end is it's done. I mean, it's done by the contractor. How it gets done is you're gonna have to work with them.
But we get that that's a huge lift for especially the managers on here, right? To try to deal with the access and scheduling and having the ability to do this work in all these different units. So to the extent that you're able to have a contractor and of course, we can all tell you there's a shortage of contractors to do this work. So beggars can't be choosers here, but we want to make sure that it's as easy for the board and the manager as possible so that you're not, having to have some person literally walk around and supervise, each project in each unit. If the unit owners are able to coordinate and do that part of this job, it's going to make it a heck of a lot easier for everybody involved.
One more question. Given the propensity for mulch fires in this area, would it be beneficial from an insurance premium basis to replace mulch with rock or some other fire retardant medium? Yes.
Well, that's the last thing they're looking at right now.
Yeah.
Just get those grilled. I mean, sure, if you've had a history of mulch fires, 100% prove what you're going to do to prevent further claims. But that's not a question on the applications right now.
I've
saying it
never been
won't be.
asked about mulch.
Yeah.
But I've not seen one underwriter ask about it. And I've frankly not seen a lot of claims for mulch fires, maybe one in my career.
I've seen questions based on mulch as it relates to playgrounds. What is the surface of the play made of? That's
Yeah.
really my only recollection.
Kathy?
Good. Yes, all good stuff. For those that were having problems logging in, I see that some people were able to do it. So we will definitely send the recording out to everybody. I guess there was a little glitch with our glue up system. So I apologize for those that were having issues. Our next event is a maintenance roundtable, which will be virtually through webinar. That will be on June the 7th from 11 to 1. You can register at the link in the chat right now. And then we hope to see you guys at our trade show. We have 2 of them. We have the one in St. Louis on August the 8th, and we have the one in Kansas City on August the 14th. We hope to see you there, and I will get the recording out to everyone and the slideshow. So thank you, everybody. Thanks to our presenters, and I hope you guys have a great day.
Thanks,
Bye,
Bye,
everybody.
everybody.
Thanks.
Thank you, everyone.